Chapter 1: The 90-90-90 Rule, the Brutal Reality. The industry calls it the 90-90-90 Rule, a grim statistical silhouette that haunts the dreams of every retail trader who has ever clicked buy on a futures contract. The math is as cold as it is consistent. 90% of new traders will lose 90% of their money within the first 90 days of opening an account. It is the unwritten law of the exchange, a natural selection process that operates with ruthless efficiency. While the flashy advertisements on your social media feed promise a life of tropical beaches and high-leverage luxury, the data suggests a far different destination, a swift, expensive lesson in humility that ends before the third month's rent is due. This failure rate isn't a glitch in the system, it is the system's fuel. The futures market is a closed-loop ecosystem, a zero-sum game where wealth is not created, but merely redistributed. Every dollar that flashes green on a professional's screen was bled out of the account of someone less prepared, less disciplined, or less informed. To enter this arena is to engage in a high-stakes transfer of risk where your ignorance is someone else's profit margin. The get-rich-quick allure is the bait in a trap designed to attract liquidity. The market needs your capital to pay the winners, and it has become incredibly efficient at harvesting it from the hopeful. We are lured in by the siren song of leverage, the intoxicating idea that a few $1,000s can control hundreds of thousands in crude oil, gold, or equity indices. It feels like a superpower until the first minor tremor in price works against you. Novices often mistake the market for a benefactor or a puzzle to be solved, when in reality, it is a meat grinder of human psychology. Behind the blinking lights of the price ladder lies an arena populated by high-frequency algorithms, institutional banks, and seasoned predators who have spent decades perfecting the art of taking money from the dumb money. Understanding the 90-90-90 rule is the first step toward avoiding becoming a part of its statistics. You cannot survive a desert if you believe you are walking into an oasis. To trade futures successfully, you must first strip away the marketing facade and confront the brutal reality that the odds are stacked against you from the moment you fund your broker account. This book is not about finding a holy grail indicator. It is about understanding why the trap exists, how it is set, and how you can fundamentally change your approach to ensure you aren't the one paying for a professional's dinner. Chapter 2: The Original Intent. Why the market wasn't built for you. To understand the precarious position of the retail trader, one must first strip away the flashing neon of modern trading platforms and return to the soil. The futures market was not birthed in a glass-walled Silicon Valley office. It was forged in the mud of mid-19th century Chicago. It was a pragmatic, grit-under-the-fingernails solution to the feast-or-famine volatility of agricultural cycles. Farmers needed to lock in a price for their grain before it was even harvested to avoid bankruptcy if prices plummeted, while millers needed to guarantee their supply costs to keep their businesses running. At its core, a futures contract was never meant to be a vehicle for a quick buck. It was a sophisticated insurance policy designed for people who actually touched the products they traded. When you enter a trade today, you are stepping into an ecosystem built by and for these industrial titans, the hedgers. For a global airline or a massive grain elevator, the futures market is a tool for risk management, not a casino. These players have skin in the game that extends far beyond a digital ledger. They have silos full of wheat and hangars full of jets. The entire architecture of the exchange, from the contract sizes to the delivery specifications, was meticulously calibrated to serve these institutional needs. The market's DNA is encoded with a bias toward those who use it to offset the risks of their massive physical business operations, leaving the unequipped novice to navigate a landscape where they are fundamentally an outsider. This structural disconnect is where the beginner's trap first takes hold. The retail trader views a gold or oil contract as a series of ticks on a chart, a purely mathematical abstraction. However, the institutional side of the trade is backed by an army of supply chain experts, meteorologists, and logistics officers who understand the underlying reality of the asset. When you buy a contract, you are often taking the other side of a trade from someone who knows more about the product than you ever will. You are playing a game of poker where your opponent designed the deck and wrote the rules to ensure their own survival. Furthermore, the mechanical levers of the market, leverage, margin calls, and tick values, were standardized for firms with deep pockets and professional risk compliance departments. For a multi-billion-dollar hedge fund, a sudden price swing is a calculated line item. For a novice with a $5,000 account, that same swing is an extinction event. The market wasn't built to be fair in the sense of protecting the small player. It was built to provide liquidity for the giants. By participating without recognizing this history, the beginner is essentially bringing a pocket knife to a war zone designed for heavy artillery, mistakenly believing that because they have access to the platform, they have an equal chance at the prize. Chapter 3: The Leverage Trap. The Illusion of Buying Power. In the neon-lit excitement of a first trading account, leverage feels like a superpower. It is the broker's ultimate marketing hook. The promise that with a mere $1,000, you can command the market force of 100,000. To the novice, this looks like the democratization of wealth, a golden ladder that allows the small player to climb into the arena of giants. You crunch the numbers on a legal pad, eyes widening as you realize that a symbolic 1% move in the underlying asset could double your net worth in an afternoon. This is the illusion of buying power, a psychological trick that reframes a high-stakes loan as a generous gift. In reality, leverage is not a power boost. It is a magnifying glass held over a candle. While it intensifies the light of your gains, it exponentially increases the heat of your risks. The beginner often fails to realize that the market does not care about the size of their controlled position, only the thinness of their safety net. When you are leveraged 50 to 1, you are not trading with strength. You are walking a tightrope thin as a razor blade. You have surrendered your staying power, meaning you no longer have the luxury of being right eventually. You must be right immediately, or you will be extinguished. The catastrophe usually arrives not as a crash, but as a margin call, a clinical, automated notification that functions as a financial death warrant. Because you are trading on borrowed capital, the broker's primary concern is their own solvency, not your dreams. The moment the market ticks against you by a fraction, your maintenance margin evaporates. Without the capital to plug the gap, the system's algorithms will liquidate your position in a heartbeat, selling your assets into a falling market to protect the house. You are left staring at a screen of zeros, wondering how a minor 2% fluctuation in price resulted in a 100% loss of your life savings. This is the sting of the double-edged sword. It offers the reach of a titan, but possesses the fragility of glass. Chapter 4: Meet the Sharks. Who is on the other side of your trade? When you click the buy button on your laptop from the comfort of your home office, it is easy to imagine that your counterpart is someone just like you. Perhaps another retail trader in a different city, scanning the same moving averages and feeling the same nervous excitement. This is the first and most dangerous delusion of the novice. In the futures market, you aren't playing a friendly game of poker at a kitchen table. You have stepped into a high-stakes arena where the house doesn't just provide the cards, it plays the hand. On the other side of your screen is a digital leviathan, a composite of billion-dollar hedge funds, massive institutional banks, and high-frequency trading firms that measure their reaction times in microseconds. These sharks do not trade based on hope or gut feelings. They operate through sophisticated algorithms, math-driven engines, capable of executing thousands of orders before you can even blink. While you are trying to remember where to set your stop-loss, these algos are scanning the entire order book, identifying pockets of retail liquidity, and hunting for the very emotions you are struggling to suppress. They are designed to exploit the predictable patterns of human fear and greed. For a market maker or a high-frequency firm, your entry signal is often their exit liquidity, and your panic is their profit margin. To understand the sheer scale of the mismatch, you must realize that you are competing against teams of PhD physicists and elite data scientists whose sole job is to ensure the market remains efficient, which is often a polite way of saying they are designed to take the money of the uninformed. These institutional players, or whales, move the market with a gravity that a retail account cannot hope to mimic. They possess information advantages, tier 1 data feeds, and execution speeds that make your residential internet connection look like a relic of the Stone Age. They are not your friends, and they are certainly not your peers. In this ecosystem, the novice trader is often viewed as the dumb money, a predictable source of fuel for the larger machine. Every time the market whipsaws, just enough to hit your stop loss before reversing in your original direction, you aren't a victim of bad luck. You are a victim of a calculated hunt. The sharks know exactly where the retail crowd hides their orders. To survive this environment, you must stop thinking of the market as a chart of lines and candles and start seeing it for what it truly is, a predatory landscape where the only way to avoid being eaten is to understand exactly how the hunters operate. Chapter 5: The Speed Gap. Algorithms versus human reflexes. The retail trader sits in front of a dual monitor setup, finger hovering over the mouse, watching a breakout form in real time. To the human eye, the candle flickers and jumps, a visual representation of supply and demand battling for dominance. But the real-time data flickering on that screen is a ghost, a delayed echo of an event that has already been analyzed, processed, and exploited by machines housed in climate-controlled server farms a few miles from the exchange. By the time your brain sends the signal to click buy, the institutional algorithms have already moved in and out of the position 3 times, harvesting the micro fluctuations that you didn't even know existed. This is the brutal reality of the speed gap. In the world of futures, time isn't measured in minutes or even seconds, but in microseconds. While you are navigating a browser-based platform or a mobile app, institutional hardware is utilizing fiber optic straight-through processing and co-located servers that sit physically next to the exchange's matching engine. For the novice, the delay between seeing a price and having an order filled, known as latency, is a tax on your potential. You aren't just competing against other people. You are competing against the laws of physics, and you are starting the race with lead weights strapped to your ankles. The most visible symptom of this technological inferiority is slippage, the silent killer of retail accounts. You click to enter at 4500.25, but by the time your order travels through your internet provider, hits your broker's server, and finally reaches the exchange, the price has moved to 4500.75. That half-point difference might seem negligible in the moment, but across hundreds of trades, it creates a mathematical drag that few beginners can overcome. You are essentially paying a premium to enter a trade and accepting a discount to exit it, all because your tools are bringing a knife to a digital gunfight. Ultimately, the beginner's trap is believing that a fast internet connection and a pro subscription to a charting site bridge this divide. It doesn't. Institutional algorithms are designed to sniff out retail order flow, front-running the very momentum you are trying to capture. While you are waiting for a chart pattern to confirm on a 5-minute candle, the HFT high-frequency trading systems have already vacuumed up the liquidity and moved the goalposts. In the futures market, if you are seeing the opportunity at the same time as everyone else, you are likely the liquidity that the algorithms are about to consume. Chapter 6: The Lottery Ticket Syndrome. The human brain is evolutionarily hardwired for survival, yet it possesses a fatal glitch when confronted with the flashing green and red lights of a trading terminal, the dopamine-fueled promise of the jackpot. We call it the lottery ticket syndrome, a psychological state where the trader ceases to be a strategic market participant and becomes a frantic gambler. In this mindset, the complex global economy is stripped of its nuance and reduced to a digital slot machine. The novice isn't looking for a sustainable career or a 10% annual return. They are looking for the one big trade that will liberate them from their 9-to-5 existence. This desperation for an exit ramp from reality creates a cognitive fog that makes high-risk, low-probability setups look like once-in-a-lifetime opportunities. Every time a novice clicks buy on a highly leveraged position, their brain receives a hit of neurochemical anticipation far more potent than the satisfaction of a realized profit. This is the same neurological mechanism that keeps players at the craps table until their pockets are empty. In the world of futures trading, this manifests as the hunt for moonshots, taking outsized positions in volatile markets without a stop loss, driven by the seductive whisper that this time will be different. The market, however, is an indifferent predator. It does not care about your student loans, your dissatisfaction with your boss, or the vision board in your office. When you treat the futures market like a casino, the house eventually wins. And in this arena, the house is the disciplined institutional trader waiting to swallow your lottery ticket investment. The tragedy of the get rich quick mentality is that it forces an amateur to ignore the very tools that could actually make them wealthy over time. Risk management, position sizing, and technical analysis feel agonizingly slow to someone who wants a Ferrari by Friday. To the victim of lottery ticket syndrome, a calculated 2% gain feels like a failure, while a reckless 50% gamble feels like progress until the inevitable margin call arrives. This fundamental mismatch between expectation and reality is the primary reason the 90% fail. They aren't losing to the market, they are losing to their own inability to delay gratification, turning a professional discipline into a desperate high-stakes game of chance that they are mathematically destined to lose. Chapter 7: Cognitive Sabotage. Why your brain wants you to fail. Your brain is a masterpiece of biological engineering, honed over millions of years to keep you alive in a world of physical predators and scarce resources. It is wired for survival, belonging, and the rapid identification of patterns. However, the very instincts that saved your ancestors from a saber-toothed tiger are the same neurological impulses that will systematically drain your trading account. In the cold, counterintuitive environment of the futures market, your gut feeling isn't a superpower. It is a sophisticated piece of sabotage. When you enter a trade, you aren't just fighting the institutions or the algorithms. You are fighting a biological inheritance that views a fluctuating price chart as a life or death threat. The most lethal of these internal glitches is loss aversion, the psychological phenomenon where the pain of losing is twice as powerful as the joy of gaining. Evolutionarily, this made sense. Missing out on a meal was a setback, but losing a limb was terminal. In trading, this manifests as the disposition effect, the devastating tendency to prune your flowers and water your weeds. You capture small profits early to lock in a sense of safety, but you hold on to hemorrhaging losses, paralyzed by the hope that the market will return to break even so you don't have to process the chemical sting of failure. Your brain would rather go bankrupt than admit it was wrong. Beyond the fear of loss lies the seductive trap of the gambler's fallacy, a cognitive shortcut that convinces you the universe owes you a correction. After a string of 5 green candles, your brain insists the market is due for a reversal, as if the price action has a memory or a sense of fairness. It doesn't. The market is a series of independent events, indifferent to your streaks or your expectations. When you combine this with confirmation bias, the tendency to hunt for a single lone indicator that supports your trade while ignoring 10 others that scream sell, you create a reality tunnel that leads straight to a margin call. To trade successfully, you must learn to distrust yourself. You must build a system that acts as a straitjacket for the ancient, irrational impulses of the prehistoric mind. Chapter 8: The Guru Scam. The Business of Selling False Hope. The modern trading landscape is haunted by a paradox. If a trader had truly unlocked the secret to a consistent 1,000% annual return, why would they spend 14 hours a day editing TikTok videos and managing an affiliate sales funnel? The uncomfortable truth is that for many of the most visible gurus in the space, the actual act of trading is merely a backdrop, a stage prop used to sell the real product. Their true expertise lies not in reading candlesticks or calculating Fibonacci retracements, but in the art of lifestyle engineering. They sell the dream of the laptop lifestyle because it is far more profitable and infinitely more predictable than the volatile reality of the futures market. Peer behind the curtain of the high-energy webinars and the limited-time discount codes for 5-figure masterclasses, and the business model begins to unravel. You are not witnessing a master educator at work. You are observing a sophisticated marketing machine designed to exploit the very desperation that leads people to trading in the first place. These finfluencers operate on a volume game. They don't need their students to become successful traders to stay in business. They only need a fresh influx of novices who are tired of their 9 to 5 grinds and are looking for a shortcut. In this ecosystem, the student is not the protege. The student is the exit liquidity. The guru scam thrives on a cocktail of survivorship bias and fabricated transparency. You'll see the curated screenshots of massive profits and the polished videos filmed in front of rented exotic cars, but you will never see the verified tax returns or the audited brokerage statements. These mentors provide just enough technical jargon to sound authoritative, wrapping basic concepts available for free on YouTube in a shroud of proprietary secrets. They build a psychological trap by convincing you that if their system isn't working for you, it isn't a flaw in the strategy. It's a flaw in your mindset, often conveniently solved by purchasing their next advanced tier of coaching. To survive the beginner's trap, you must learn to distinguish between a mentor and a merchant. A true educator highlights the grueling, boring, and emotionally taxing reality of capital preservation. A scammer, however, focuses exclusively on the destination, the private jets, the beachside villas, and the ease of the one-click lifestyle. In the futures market, money is never made easily. If someone is trying to convince you otherwise for the price of a $997 course, they aren't trading the market. They are trading you. Chapter 9, The News Trap: Why Following Headlines Leads to Ruin. The glowing ticker at the bottom of the television screen is designed to feel like a lifeline, a constant stream of alpha delivered straight to your living room. For the novice futures trader, a breaking news headline, a surprise interest rate hike, a geopolitical flare-up, or a sudden supply disruption feels like a gift from the gods. You see the flash of red or green, your pulse quickens, and you rush to hit the buy or sell button, convinced you are acting on information that the rest of the world hasn't fully digested yet. But in the high-speed arena of futures trading, if you are reading it on a public news site, you aren't the first to know. You are the last to react. To understand the news trap, you must understand the concept of exit liquidity. Large institutional players, the so-called smart money, manage positions so vast that they cannot simply exit a trade with a single mouse click without crashing the price against themselves. They need a surge of opposing orders to absorb their massive volume. This is where the headline comes in. When a piece of good news hits the wires, it triggers a wave of retail buying. As thousands of beginners rush in to buy the breakout, the institutions use that very influx of buying pressure to sell their massive holdings. The beginner sees a bullish catalyst. The pro sees a convenient door to the exit. This phenomenon is why so many novices find themselves staring in disbelief at a chart that is plummeting despite positive news. You bought the headline, but the market had spent the last 3 weeks buying the rumor. By the time the event becomes a public fact, the move is already exhausted. The price action hasn't failed to account for the news. It has already metabolized it, priced it in, and moved on to the next uncertainty. In this ecosystem, the news cycle functions as a lagging indicator disguised as a leading one, turning the uninformed trader into the very fuel the market needs to reverse its course. Ultimately, trading the news requires a level of psychological detachment that most beginners haven't yet developed. It requires you to look at a perfect, fundamental setup and realize that if it looks too obvious, you are likely the target of the move rather than its beneficiary. When the headlines are most certain, the market is usually at its most treacherous. To survive the news trap, you must stop treating the media as a roadmap for where the market is going and start seeing it for what it truly is, a ledger of where the market has already been. Chapter 10: The Missing Safety Net. Most novices enter the markets with the eyes of a gambler, focused entirely on the jackpot while ignoring the edge of the cliff. They spend months perfecting their entry signals, hunting for the holy grail indicator that predicts the next big move, yet they spend almost no time planning for what happens when the market disagrees with them. In futures trading, where leverage acts as a high-speed engine, driving without a seatbelt isn't just risky, it is a statistical guarantee of catastrophe. The fundamental truth that separates the professional from the amateur is simple. The professional treats capital preservation as their primary job, while the amateur treats it as an afterthought. The most common execution of this negligence is the absence of a hard stop loss. To a beginner, a stop loss feels like an admission of failure or a localized pain point they would rather avoid. They tell themselves they will wait for a bounce or that they can exit manually if things get too ugly. This is the siren song of the beginner's trap. Without a predetermined, automated point of exit, a trader is no longer making logical decisions. They are a hostage to their own hope. In the high-velocity environment of futures, a small mistake left unchecked can mutate into an account-clearing disaster in the span of a single candle. This brings us to the mathematical grim reaper of the trading world, the probability of ruin. It is a concept many novices have never heard of, yet it dictates their survival more than any chart pattern ever could. If you risk 10% of your account on every trade, you only need a brief, natural string of bad luck to find yourself in a hole so deep that recovery becomes mathematically impossible. To lose 50% of your capital requires a 100% gain just to break even, a feat few will ever achieve. Without a strict risk per trade plan that caps exposure to 1% or 2%, you aren't trading a system. You are simply waiting for your inevitable turn to go broke. Ultimately, risk management is the only safety net that exists in a marketplace designed to punish human emotion. It is the cold, hard realization that you cannot control the market, but you can absolute control how much of your money the market is allowed to take. Those who fail to respect this boundary are not being aggressive or brave. They are merely temporary participants in a game they don't yet understand. To survive the 90% failure rate, you must stop asking how much you can make on the next trade and start asking how much you can afford to lose and still be allowed to trade tomorrow. Chapter 11: Indicator Overload. The Myth of the Perfect Setup. The modern trading terminal is a masterpiece of psychological seduction. With a few clicks, a novice can overlay their charts with a kaleidoscope of Bollinger Bands, stochastic oscillators, moving average crossovers, and Ichimoku clouds until the underlying price action, the very heartbeat of the market, is buried beneath a digital scrap heap. To the beginner, this visual complexity feels like sophistication. It feels like armor. There is a seductive comfort in the idea that if you just add one more filter, one more mathematical confirmation, you can finally eliminate the terrifying element of human uncertainty. However, this quest for the perfect setup through additive complexity inevitably leads to the quicksand of analysis paralysis. When you have 20 indicators screaming for attention, they rarely speak in unison. While the relative strength index might signal an oversold bounce, the MACD histogram remains stubbornly bearish, and the Fibonacci retracement level sits just far enough away to sow doubt. By the time every flickering line finally aligns in a rare, harmonious green light, the move has usually already happened. The novice isn't buying at the start of a trend. They are buying the exhaustion point, entering the market just as the professional traders, who were watching nothing but raw price and volume, are hitting the exit. The myth of the perfect setup rests on the flawed belief that the market is a puzzle to be solved with more data points, rather than a living tide of collective human emotion. In futures trading, more information does not equate to more edge. Often, it simply provides a more expensive way to be wrong. This chapter is about stripping away the clutter. To survive the 90% failure rate, you must realize that a chart covered in indicators isn't a map to hidden treasure. It's a fog of your own making, designed to protect you from the responsibility of making a decision in the face of the unknown. Chapter 12: Death by 1,000 Cuts, Commissions and Slippage. In the sterile glow of a trading monitor, a net profit of $0 looks like a draw, a stalemate between you and the market. But in the world of high-frequency futures trading, a break-even trade is actually a quiet defeat. Most novices enter the arena focused entirely on the direction of the price, believing that if they can just predict where the E-mini S&P 500 or crude oil is headed, the battle is won. They treat the market like a digital scoreboard, oblivious to the fact that every time they click buy or sell, a microscopic tax is levied against their survival. This is the friction of the machine, a relentless grinding of gears that turns a stagnant account into a dying one. To the uninitiated, a commission of a few dollars per round turn seems like a rounding error, a small price to pay for admission to the greatest casino on earth. But for the beginner who overtrades in an attempt to catch every scalp and minor fluctuation, these fees are a slow-acting poison. If you are scraping for 2 ticks of profit while paying half a tick in commissions and exchange fees, you aren't just trading against other participants. You are running an uphill marathon in a suit of lead armor. By the end of the month, a trader with a 50% win rate, theoretically a stable position, often looks at their statement only to find their equity has been hollowed out from the inside, leaving behind nothing but a carcass of transaction receipts. Then there is the ghost in the machine, slippage and the bid-ask spread. This is the hidden cost of liquidity, the invisible tax that occurs when your order is filled at a price slightly worse than you intended. In the heat of a volatile breakout, that 1 tick difference between your limit order and the actual fill feels like a minor annoyance. However, when multiplied by hundreds of trades, slippage becomes a torrential leak in your financial plumbing. It is the silent killer of the paper millionaire. A strategy that looks flawless on a spreadsheet often collapses in the real world because the novice failed to account for the reality that the market does not move for free. You aren't just fighting the charts, you are fighting the cost of the fight itself. Chapter 13, The Revenge Cycle. Digging a deeper hole. The market does not know you exist, yet after a stinging loss, it feels personal. You stare at the red numbers on your screen as if the candle charts have mocked your intelligence and picked your pocket. In this volatile moment, a dangerous chemical cocktail of adrenaline and cortisol floods the brain, clouding the prefrontal cortex, the part of you responsible for rational decision-making. The loss is no longer just a line item in a ledger. It is a wound that demands immediate cauterization. This is the birth of the revenge cycle, that frantic, desperate urge to get it back from the very entity that just took it from you. When you enter a trade to recover a previous loss, you are no longer trading the market. You are trading your own ego. The objective technical setup that guided your initial strategy evaporates, replaced by a frantic search for any signal, no matter how weak, that justifies re-entering the fray. You double your position size to fast-track the recovery, convinced that the market owes you a reversal. But the market is an indifferent force of nature. It has no memory of your previous trade and no obligation to return your capital. By trying to force a win out of spite, you abandon the discipline of a trader and adopt the desperation of a gambler, chasing a losing streak at a blackjack table. The irony of revenge trading is that it creates a feedback loop of mounting catastrophe. Because you are trading under emotional duress, your timing is almost always off, and your risk management is non-existent. When the second recovery trade inevitably turns against you, the psychological blow is twice as heavy. You began the day down a few $100s. Now, you are down thousands, and the hole you've dug is so deep that you can no longer see the light of your original strategy. At this stage, professional novices don't just lose money, they lose their mental capital, shattering the confidence required to execute the next valid setup. Breaking the cycle requires an admission that many find unbearable. The money is gone. The moment a stop loss is hit, that capital ceases to be yours. It belongs to the market's liquidity. To trade effectively again, you must detach your self-worth from the P&L curve and step away from the screen until the heartbeat slows and the desire for vengeance fades. Digging harder only works if you are looking for a vein of gold, but in futures trading, digging while angry only ensures that you are burying your own account. Chapter 14. Volatility, the beginner's best friend and worst enemy. To the uninitiated eye, a vertical price spike on a chart looks like a fast track to wealth. It is the siren song of the market. The promise that in a matter of seconds, a single trade could yield more profit than an entire week of disciplined scalping. Beginners are instinctively drawn to high-output volatility like moths to a blowtorch, convinced that the speed of the move is an advantage. They see a high-impact news event, a consumer price index release, or a Federal Reserve announcement as a shortcut. In reality, these moments of extreme turbulence are not opportunities for the novice. They are precision-engineered liquidation events designed to wash out those with small accounts and shaky hands. The paradox of volatility is that while you need movement to make money, too much movement will almost certainly make you lose it. In a low volatility environment, price moves like a hiker on a well-marked trail. In a high volatility environment, it moves like a cornered animal. For a retail trader with a modest account, the primary issue isn't being wrong about the direction, it's being right at the wrong time. During a data release, the bid-ask spread widens into a canyon, and slippage becomes a silent thief. You may enter a buy order at a specific price, only to find yourself filled 10 ticks higher, already underwater before the chart candle has even formed. Most beginners fail to realize that volatility is a double-edged sword that cuts deepest at the point of the stop loss. To protect your capital, you likely place a stop a reasonable distance from your entry. However, during periods of peak volatility, the market doesn't just trend. It breathes in violent, jagged spasms known as whipsaws. These are the erratic north and south movements that happen milliseconds before the real trend establishes itself. For a professional with $1 million cushion, these swings are noise. For a novice, they are a death sentence. Your stop loss is triggered by a momentary shadow, and just as your account realizes the loss, the market pivots and heads exactly where you originally predicted, leaving you standing on the sidelines with an empty pocket. Trading during high-impact news is less like strategic investing and more like trying to perform landscape photography in the middle of a hurricane. You might catch a glimpse of something beautiful, but the odds are much higher that you'll be swept away by the debris. The beginner's trap here is the ego-driven belief that you can outsmart the chaos. You see the flashing green and red numbers and feel a rush of adrenaline, mistaken for intuition. But in the world of futures, speed is the enemy of the undercapitalized. Until you learn that the best trade during a news spike is often the one you never take, you will continue to provide the liquidity that seasoned pros use to fund their own exits. Chapter 15: Overtrading. The compulsion to be in the market. The psychological weight of a quiet screen is one of the most underestimated enemies in a trader's career. For the novice, a day without an active position feels like a day wasted, a failure of nerve, or a missed opportunity for profit. This restlessness is the itch, a physical manifestation of the belief that wealth is generated through constant activity. In the high-octane world of futures, where the candles flicker with hypnotic speed and the leverage allows for life-changing swings, the silence of a flat position can feel deafening. You begin to hunt for patterns that aren't there, bending your rules just enough to justify a click, convincing yourself that being a spectator is synonymous with being a loser. In reality, the market does not pay you for your attendance, it pays you for your edge. Overtrading is the ultimate tax on the impatient, a slow bleed of capital driven by the compulsion to exert control over a chaotic system. When you trade out of boredom or a desperate need to make something happen, you aren't an investor. You are a gambler who has mistaken the flashing lights of the price ladder for a video game. The beginner views a lack of trades as a lack of progress, failing to realize that your capital is your ammunition. If you fire at every shadow in the woods, you will have nothing left when the prize finally steps into the clearing. The hardest lesson to internalize is that doing nothing is often the most professional action you can take. High-level trading is 90% observation and 10% execution. It requires a paradoxical mindset, the discipline to stay alert for hours on end, coupled with the restraint to keep your hands off the keyboard until the stars align. You must transition from being a hunter who pursues everything that moves to a sniper who waits for a specific set of criteria to be met. The most profitable trade in your journal is frequently the one you had the wisdom to skip, the almost right setup that would have trapped your capital and clouded your judgment for the rest of the day. When you master the art of the wait, you reclaim your power from the market's volatility. The market thrives on your impulsiveness, relying on the fact that most people cannot sit still while there is money to be made. By refusing to give in to the compulsive need to be in the market, you separate yourself from the 90% who view the screen as a slot machine. True mastery isn't found in the number of contracts you flip or the frequency of your entries. It is found in the quiet confidence of knowing exactly when to walk away from the screen and let the noise settle. Chapter 16: Stop Loss Hunting: Why the Market Knows Where You Hide. To the uninitiated, the sudden, violent reversal of a trade right after being stopped out feels like a personal vendetta, as if an invisible eye is watching your specific screen, waiting for you to surrender. You place your stop loss just a few ticks below a visible support level, precisely where the textbooks told you to, only to watch the price dip just far enough to trigger your exit before screaming back in the direction of your original thesis. This isn't bad luck, nor is it a glitch in the software. It is a fundamental mechanic of the futures market known as liquidity hunting, and it is the process through which the whales of the industry find the fuel they need to move the price. Large institutional players, banks, hedge funds, and high-frequency algorithms operate on a scale that the retail trader can barely comprehend. They cannot simply enter a multi-thousand contract position at a single price without causing massive slippage and destroying their own profit margins. To fill their massive orders, they need a counterparty. They need a pool of sell orders to buy from or buy orders to sell into. Your stop loss, along with the thousands of others clustered at obvious technical levels, represents that pool. In the cold calculus of the market, your exit is their entry. This creates a predatory dynamic where market makers engineer price movement toward these areas of high density. When the price hovers near a well-defined support line, the big money knows that a massive cluster of sell stops is sitting right underneath it. By pushing the price into that zone, they trigger a cascade of forced selling. This flood of sell orders provides the necessary liquidity for the giant to buy up those same contracts at a discount. Once the retail weak hands have been shaken out and the institutional hunger is satisfied, the downward pressure vanishes, and the price snaps back, leaving the novice trader sidelined and bewildered while the market finally makes the move they had originally predicted. Chapter 17: The Absence of Edge: Guessing versus Probabilistic Thinking. The siren song of the futures market is often built on the illusion of intuition. For the novice, a trade begins with a feeling, a hunch that the S&P 500 has fallen too far or that gold is bound to break out. This is the psychological abyss known as the guessing trap. To the untrained eye, these guesses feel like informed decisions because they are often dressed up with a single moving average or a frantic glance at a news headline. In reality, without a verifiable edge, these traders are not participants in a financial market. They are patrons of a global casino, playing a game where the house edge is hidden behind commissions, slippage, and the sheer randomness of short-term price action. A true trading edge is not a prediction of the future. It is a clinical observation of the past applied to the uncertainty of the now. It is a statistical advantage that ensures, over a sufficiently large sample size of trades, the wins will outweigh the losses. To move from guessing to probabilistic thinking requires a radical shift in identity. You must stop seeing yourself as a visionary who knows where the market is going and start seeing yourself as a casino operator. The operator doesn't care if the next player wins a hand at the blackjack table, because they know the math of the game ensures the house will be profitable by the end of the month. If you cannot articulate your edge in a single sentence backed by historical data, you are currently the player, not the house. The bridge between gambling and professional trading is built out of backtesting and rigorous documentation. Most beginners fail because they risk capital on a strategy that has never survived the scrutiny of a spreadsheet. They treat every loss as a personal failure and every win as a stroke of genius, never realizing that in the absence of a statistically significant system, both outcomes are equally meaningless. Transitioning to a probabilistic mindset means detaching from the outcome of any single trade and focusing entirely on the execution of the process. Before you risk a single dollar, you must have the certainty that comes from knowing your system has survived 1,000 simulated battles. If you haven't done the math, you aren't trading. You're just hoping. And in the futures market, hope is a remarkably expensive luxury. Chapter 18: The Exhaustion Factor: Decision Fatigue and Burnout. The The human brain is not a biological machine designed for the infinite variability of the financial markets. In the first few hours of a trading session, your mind is a precision instrument, sharp, analytical, and disciplined. You weigh risk to reward ratios with clinical detachment. But every candle flickered, every tick moved, and every split-second choice to hold or fold consumes a finite resource known as cognitive energy. By the time the mid-afternoon lull rolls around, you aren't just trading against a global pool of liquidity. You are trading against a mounting pile of mental sludge. Decision fatigue in trading is a silent predator because it doesn't announce its arrival with physical pain. Instead, it manifests as a subtle erosion of your standards. The high probability setup you waited for at 9:30 a.m. suddenly feels too slow at 2 p.m., leading you to take boredom trades or revenge entries that violate every rule in your plan. When the prefrontal cortex, the part of the brain responsible for impulse control, is exhausted, the primal emotional brain takes the wheel. This is the exact moment when a professional operation transforms into a desperate gambling spree, driven by the biological urge to just make something, anything, happen. The most catastrophic account blowups rarely happen when a trader is fresh and alert. They happen in the fog of war that follows 6 hours of staring at blinking red and green numbers. This mental exhaustion creates a feedback loop of failure. You make a tired mistake, the loss triggers a spike of cortisol and adrenaline, and instead of walking away to recover, the stress compels you to double down to get it back. You are no longer navigating the markets. You are struggling to keep your head above water in a sea of your own depleted willpower. Burnout in this industry isn't just about working too many hours. It's about the intensity of the choices made within those hours. A surgeon or a pilot understands that their peak performance has a hard expiration date for safety reasons. Yet the novice trader believes they can outwork the market by tethering themselves to the screen from open to close. The irony of the beginner's trap is that the harder you try to force a result through sheer stamina, the more likely you are to commit the fatal errors that lead to ruin. True longevity in trading requires the wisdom to know when your brain has clocked out, even if the markets are still open. Chapter 19, The Martingale Fallacy. Why averaging down kills accounts. It usually starts with a flicker of disbelief. You bought a long contract at a key support level, convinced the market was ready to pivot, but the price sliced through your entry point like a hot wire through wax. At this precise moment, the beginner's trap snaps shut. Instead of admitting the thesis was wrong and cutting the loss, a seductive thought takes hold. If I like the trade at $50, I should love it at $48. You decide to double your position to lower your average entry price, convinced that a minor retracement will now bring you back to break even twice as fast. You are no longer trading the market. You are negotiating with your own ego. This is the siren song of the martingale strategy, the dangerous art of averaging down. In the controlled environment of a textbook, it looks like a mathematical masterstroke. In the volatile arena of futures trading, however, it is the primary engine of account liquidation. Beginners mistake this tactic for a show of conviction, but more often than not, it is a psychological defense mechanism fueled by hopium. By adding to a losing position, you aren't just doubling your risk, you are marrying your mistake. You have replaced a calculated strategy with a desperate prayer that the market will stop being wrong before you run out of margin. The professional trader knows that the first loss is usually the cheapest loss. They understand that a trade move against them is valuable information. It's the market telling them their timing or direction was flawed. To the novice, however, a red screen is a personal insult that must be corrected through sheer financial force. This is where the physics of the trap become lethal. Because futures are highly leveraged, the math of averaging down works against you exponentially. A 10% move against a single position is a bruise. A 10% move against a tripled down position is a terminal hemorrhage. To escape the martingale fallacy, one must embrace a painful truth. The market doesn't know where you entered, and it certainly doesn't care about your average price. Every time you double down to lower your break-even point, you're effectively betting that your original, incorrect analysis is about to miraculously become right. You are throwing good capital after a bad idea, hoping that volume can compensate for a lack of discipline. In the world of high-speed futures, this isn't just a tactical error, it's a slow-motion suicide mission disguised as a pro move. Chapter 20. Size Matters. The correlation between risk and panic. The screen doesn't lie, but it does distort. When you enter a position that is too large for your account, and, more importantly, too large for your nervous system, the flashing numbers cease to represent market data and begin to represent survival. At a responsible size, a 10-tick move against you is a minor data point, a shrug of the shoulders, or a calculated cost of doing business. But when you are heavy, that same 10-tick move feels like a physical blow to the solar plexus. Your vision narrows, your heart rate spikes, and the logical framework you spent hours building vanishes, replaced by a desperate, primitive need to make the pain stop. This is the physiological threshold of risk. Every trader has a panic point, a specific dollar amount where the frontal cortex, the seat of rational decision-making, hands the controls over to the amygdala. The tragedy of the beginner is that they often cross this line before the first candle even closes. When you trade with excessive size, you aren't just risking your capital, you are sabotaging your ability to think. You cannot follow a disciplined exit plan when your brain is screaming that a single bad minute could wipe out a month of hard-earned wages. You stop trading the chart and start trading your P&L, a cardinal sin that leads to the frantic, impulsive revenge, moves that define the 90%. The correlation is simple and deadly. As position size increases, your capacity for patience decreases at an exponential rate. A trader with a microscopic position can sit through a 3-hour consolidation phase with the calm of a Zen monk, waiting for the eventual breakout. That same trader, loaded to the hilt with maximum leverage, will interpret every minor fluctuation as a life or death crisis. They will cut winning trades too early out of sheer terror that the profit might vanish. And they will hold losing trades too long because the realized loss is too psychologically devastating to accept. True professional edge is not found in a secret indicator, but in the mundane mastery of position sizing. By keeping your risks small enough to be boring, you effectively remove the emotional charge from the trade. Discipline is easy when there is no panic. It is nearly impossible when your entire financial security is tethered to every tick of the E-mini S&P 500. To master the market, you must first master the scale of your own fear, ensuring that your size never outpaces your sanity. Chapter 21. The Paper Trading Paradox: Why Virtual Wins Don't Equal Real Cash. To the uninitiated, paper trading feels like a cheat code for the financial markets, a risk-free laboratory where you can test your hypotheses without the looming threat of bankruptcy. You spend weeks clicking buttons on a simulator, watching your digital account swell with imaginary profits, and you begin to feel a sense of mastery. The mechanics are identical to the real world. The bid-ask spreads are there, the charts move in real time, and the order types function exactly as they should. On paper, you are a disciplined strategist, a cold-blooded executor who never misses an entry. But this confidence is built on a fundamental misunderstanding of what trading actually is. You aren't learning how to trade the market. You are simply learning how to use the software. The paradox lies in the missing ingredient, the physiological agony of a drawdown. When you lose $500 of monopoly money on a screen, your heart rate remains steady and your palms stay dry. You can shrug off a losing streak with a simple reset of the demo account, treating your failures as glitches in the matrix rather than reflections of your judgment. In the real world, however, that same $500 represents hours of labor, a mortgage payment, or a family vacation. When real equity is on the line, the prefrontal cortex, the logical, planning part of your brain, often gets hijacked by the amygdala. The fight-or-flight response kicks in, and suddenly, the disciplined plan you practiced so diligently on the simulator evaporates in a cloud of panic and hesitation. This disconnect creates the paper trade trap. Novices often spend months in the simulated world, reinforcing a false sense of security that actually makes them more vulnerable when they go live. They mistake a high win rate in a vacuum for a high skill level in a storm. Because there is no skin in the game, the paper trader never has to confront the demons of greed and fear. They haven't felt the physical nausea of watching a position go against them in a high leverage environment, nor have they experienced the euphoric blindness that leads to overleveraging after a win. These are the true obstacles to profitable trading, and they are entirely absent from the virtual experience. The transition from the simulator to the live market is not a step, it is a chasm. To bridge it, you must recognize that paper trading is only for learning the how, not the who. It teaches you how to place an order, but it cannot teach you who you become when the market starts taking your money. The only way to survive the transition is to start small enough that the emotional weight is manageable, yet real enough that the losses sting. You cannot learn to swim by watching a video, and you cannot learn to trade without the sweat that comes from knowing that, for the first time, your mistakes actually have consequences. Chapter 22: The Boring Path to Success, Records and Routines. The siren song of the markets is composed of flashing green candles, instant gratification, and the high-octane thrill of the win. But in the cold light of the professional trading floor, the music sounds different. It sounds like the rhythmic scratching of a pen against a notebook, or the steady, monotonous click of data being entered into a spreadsheet. While the novice is busy chasing the next explosive setup, the professional is occupied with the dull, repetitive labor of maintenance. This is the great irony of futures trading. To achieve extraordinary financial results, you must master a process that is, by all accounts, incredibly boring. The transition from a losing amateur to a surviving professional begins the moment you stop looking for a better indicator and start looking for a better mirror. That mirror is your trade journal. A journal is not merely a list of entries and exits. It is a surgical autopsy of your decision-making process. It forces you to confront the gap between what you planned to do and what you actually did when the heat of the market was rising. For most beginners, this is the hardest part of the journey because it strips away the ego. It transforms a bad break into a documented error and a lucky win into a dangerous lapse in discipline. Professionalism is built on the back of routines that occur long before the first order is placed and long after the last position is closed. It is the ritual of the pre-market checklist, the stubborn adherence to risk parameters, and the exhaustive weekend review of every mistake made during the week. This is the unglamorous work that the 90% refuse to do. They want the profit without the paperwork, the glory without the grind. But in the world of futures, your survival is directly proportional to your ability to find comfort in the mundane. Success in this business is not a sprint fueled by adrenaline. It is a marathon sustained by documentation. When you treat your trading like a hobby, it pays you like a hobby, which is to say, it costs you a lot of money for the entertainment. When you treat it like a dull, rigorous business, it begins to yield professional results. The path forward isn't found in a new algorithm or a secret strategy. It is found in the quiet, disciplined hours spent reviewing your records, refining your routines, and realizing that being a successful trader is actually quite tedious. And that is exactly how it should be. Chapter 23: Know Thyself. Are you built for the futures market? The futures market is a hall of mirrors designed to exploit every flicker of human instability. Before you open a margin account or chart your first candlestick, you must confront a cold, clinical reality. The most sophisticated trading algorithm in the world cannot save a pilot who panics at the first sign of turbulence. This arena does not just demand financial capital, it demands a specific psychological constitution. To succeed here, you must be comfortable living in the razor-thin gap between calculation and chaos, possessing a temperament that views a five-figure swing not as a personal crisis, but as a data point. Honest self-assessment begins with one uncomfortable question: how do you react when you are wrong? In most professions, being wrong is a hurdle to be navigated through explanation or overtime. In futures trading, being wrong is an immediate, punishing expense that compounds with every second of denial. If your ego is tied to being right, or if you have a habitual need to prove the market wrong through revenge trading, you are already underwater. The futures market effectively functions as a high-speed centrifuge, spinning until it finds the smallest crack in your discipline and widening it until your capital leaks out. Furthermore, you must evaluate your relationship with uncertainty. Investors in the equity markets can often find solace in long-term dividends or the fundamental strength of a blue-chip company, but a futures contract is a decaying asset on a ticking clock. It is an environment of constant high-stakes decision-making under pressure. If you are someone who loses sleep over a fluctuating savings account balance or finds yourself checking prices 10 times an hour with a racing pulse, the leverage inherent in futures will eventually become a psychological poison. Ultimately, the futures market is not an egalitarian landscape. It is a ruthless meritocracy of temperament. It requires a rare paradox of personality. You must be aggressive enough to pull the trigger on a trade, yet humble enough to abandon it the moment the wind shifts. Are you more enamored with the thrill of the gamble than the discipline of the process? If the answer is yes, you aren't trading. You're paying an expensive tuition for a lesson in humility. Knowing yourself means recognizing if you are built to survive the storm or if you are simply walking into it without a coat. Chapter 24. The Survivor's Blueprint, a roadmap to not failing. The transition from the 90% who fail to the 10% who survive is rarely marked by a sudden flash of genius or the discovery of a secret algorithm. Instead, it is a quiet, disciplined retreat from the edge of the abyss. To become a survivor in the futures market, you must first accept a bruising truth. The market is not a vending machine for easy wealth, but a sophisticated meat grinder designed to extract capital from the impulsive. By now, you understand that the beginner's trap is built on the pillars of overleverage, emotional reactivity, and the fatal arrogance of predicting the unpredictable. Moving forward, your goal is no longer to win every trade, but to remain in the game long enough for your edge to manifest. Becoming an informed participant means trading with a shield in one hand and a scalpel in the other. While the novice scans the horizon for how much they can gain, the survivor looks only at how much they can afford to lose. This fundamental inversion of perspective is what separates the prey from the predator. You are no longer gambling on price action. You are managing a business where the inventory is your capital and the overhead is your risk. Before the first candle of the day even forms, the professional has already accepted that they might be wrong. They are not wedded to a narrative or a bias. They are wedded to their process. To codify this shift, you must implement a rigorous gatekeeping mechanism for your capital. This is not a suggestion, but a prerequisite for survival. Every time you feel the urge to click buy or sell, you must run your intent through a filter that strips away the dopamine and the desperation. This capital preservation checklist serves as your final line of defense against the psychological traps we have explored. If a single criterion is not met, the trade does not exist. By the time you reach the end of this list, the initial rush of the sure thing usually fades, replaced by the cold, mechanical clarity required to survive another day in the pits. Chapter 25. The Infinite Game, Staying Alive in the Arena. The siren song of the quick kill is what draws most people into the futures market. But the irony of this arena is that those hunting for a sprint are almost always the first to collapse. Trading is not a project with a defined end date or a mountain with a single summit. It is an infinite game where the primary objective is simply to keep playing. In the zero-sum world of leveraged contracts, the winner isn't necessarily the one with the most sophisticated algorithm or the boldest predictions. The winner is the trader who remains standing after the reckless have been carried out on their shields. To survive, you must trade your desire for a big score, for a quiet, unwavering commitment to technical longevity. True wealth in this game is a byproduct of endurance, not luck. When you shift your perspective from monthly returns to decade-long sustainability, your entire psychological approach transforms. You stop viewing a single losing trade as a personal failure or a sign to double down. Instead, it becomes a small, calculated cost of doing business. The beginner's trap is built on the illusion of the finish line, the idea that if you just hit a certain number, you can finally stop worrying. But the market has no finish line. The moment you believe you have beaten it is the moment you become most vulnerable to a catastrophic oversight. Staying alive in the arena requires a paradoxical blend of intense discipline and profound humility. It means accepting that you will never truly master the market, only your own reaction to it. As you move forward, remember that the goal isn't to be the brightest star in the sky for a single season, but to be the one who is still placing trades with calm precision 5, 10, and 20 years from now. If you can protect your capital and your mental clarity during the inevitable storms, time becomes your greatest ally. The market will always be there, providing opportunity to those who possess the patience to stay in the game.